We're live outside Lehman Brothers headquarters, where employees are now leaving en masse following the historic bankruptcy announcement.
September 15th, 2008. Lehman Brothers, a bank that survived the Civil War, 2 World Wars, and the Great Depression, doesn't open its doors. 25,000 employees walk out carrying boxes. $600 billion gone in one day. This isn't ancient history. This is the story of how everyone's getting rich became everyone's losing everything, and how your parents' generation watched their retirement accounts cut in half while they slept. Let's talk about what actually happened. Picture 2003. Gas is $1.50 a gallon, flip phones are cutting edge, and every single person you know is talking about real estate. Your neighbor just bought his 3rd rental property. Your coworker's cousin made $80,000 flipping a house in 6 months. Everywhere you look, people are becoming millionaires from their homes. Not stocks, not businesses, houses. Here's what that looked like. A waitress in Florida making $30,000 a year walks into a bank. She wants to buy a $500,000 house. The banker smiles and says yes. No proof of income, no money down, just sign here. Sound insane? It was normal. Banks were practically begging people to take loans. They'd call you at dinner. Want to refinance? We'll give you cash. No questions. It felt like free money, and everyone took it. Meanwhile, Wall Street had discovered something they thought was genius. They took thousands of these home loans, packaged them together, and sold them as investments. They called them mortgage-backed securities. Fancy name for a simple idea. Buy a piece of thousands of home loans, collect the payments, make money. And everyone believed the same thing. Housing prices never go down. Not nationally, not all at once. That's the rule. Except it wasn't a rule, it was a belief, and it was about to be shattered. So how did we get from banks are careful to a waitress gets a $500,000 loan? 3 things happened. First, interest rates dropped. The Federal Reserve lowered rates to historic lows after 9/11 to keep the economy moving. Suddenly, borrowing money was cheap. A $200,000 house, your monthly payment just dropped by hundreds of dollars. Everyone could afford more, so everyone bought more. Second, Wall Street got greedy. Those mortgage-backed securities were selling like crazy. Investors around the world wanted them. Safe investment, steady returns, backed by American real estate. What could go wrong? So banks needed more mortgages to package and sell, but they'd already given loans to everyone with good credit. What do you do when you run out of qualified buyers? You lower your standards. Banks started offering something called subprime mortgages. These were loans to people with bad credit, no savings, unstable income, people who probably couldn't afford to pay them back. But banks didn't care. They weren't keeping these loans. They were selling them to Wall Street within weeks. It's like a game of hot potato. Nobody wanted to hold the risk. Everyone just wanted to pass it along and collect their fee. Third, the magical thinking took over. Rating agencies, the people whose job is to say, this investment is safe or this is risky, were giving these mortgage bundles their highest ratings, AAA, same rating as US government bonds. Why? Because housing prices kept going up. And if they keep going up, even bad loans look good. The person can't pay? No problem. The house is worth more now. Sell it. Collect the profit. Everyone wins. Except one problem. What happens when everyone's thinking the same thing? When teachers, construction workers, retirees, and hedge fund managers all believe the exact same story? That's when you should worry. By 2006, warning signs were everywhere. A few people, analysts, economists, investors, started sounding alarms. This doesn't make sense, they said. These loans are garbage. This bubble will pop. Wall Street laughed at them, called them idiots, doomsdayers. You don't understand the new economy, they said. But here's what they didn't understand. You can't break the rules of math. When people who make $30,000 owe $500,000, eventually the bill comes due. Something strange starts happening. People start missing mortgage payments. Not a few people, thousands, then tens of thousands. See, many of these loans weren't normal fixed-rate mortgages. They were adjustable-rate mortgages, ARMs.
The deal was simple: super low payments for 2 years, then the rate adjusts up. Banks sold them as, "Don't worry, in 2 years your house will be worth more. You'll just refinance." But in 2007, housing prices stopped going up. They started going down. Now you're stuck. Your payment just doubled. Your house is worth less than you paid. You can't refinance. You can't sell. You default. The bank takes your house. You lose everything. Multiply that by millions. Suddenly, those mortgage-backed securities on Wall Street, the ones rated AAA, they're full of loans that aren't being paid. The steady income stream stops. The value plummets. Bear Stearns, a major investment bank, has 2 hedge funds that collapse. $20 billion gone. The company says everything's fine. They're lying. Banks start looking at each other with suspicion. If Bear Stearns is in trouble, who else is? Every major bank on Wall Street had bought these toxic assets, but nobody knew who had how much. It was like playing poker when you suspect everyone's cards are terrible, including yours. Trust, the invisible glue holding the financial system together, started dissolving. Here's what that means in practice. Banks stopped lending to each other at all. Even overnight loans, the routine stuff that happens every single day to keep money flowing, froze. When banks won't lend to other banks, that's not a red flag. That's a 5-alarm fire. And everyone was about to get burned. March 2008, Bear Stearns doesn't open. They're bankrupt. A bank that survived 85 years, gone in days. JP Morgan buys them for $2 a share. The stock was $170 a year earlier. The government and Wall Street say they've contained it. They're wrong. September 7th, 2008, the government takes over Fannie Mae and Freddie Mac, the companies that back half of all mortgages in America. Cost to taxpayers? $187 billion. September 15th, 2008, Lehman Brothers collapses, the 4th largest investment bank in America, 158 years old, $600 billion in assets, gone. The government lets them fail. This is the moment everything changes. The next day, the stock market drops 500 points. Your parents' 401ks, their retirement accounts, are evaporating. Every hour, they're losing months or years of savings. September 16th, AIG, one of the world's largest insurance companies, is about to collapse. The government bails them out, $182 billion of taxpayer money. Why? Because if AIG fails, it takes down hundreds of other companies with it. The entire global financial system could unravel. Let that sink in. A company is so big that letting it die might end modern capitalism as we know it. The phones on Wall Street are ringing off the hook. Traders are screaming, executives are crying. Everyone's trying to pull their money out at once, but there's nowhere safe to put it. Banks around the world are failing. Iceland's entire banking system collapses. The British government has to take over major banks. In America, Washington Mutual, the largest savings and loan in the country, fails. Then Wachovia, then more.
And it's not just Wall Street, it's Main Street, it's every street. Construction sites shut down overnight, workers laid off. Small businesses can't get loans to make payroll, they close. Strip malls empty out. For lease signs multiply like weeds. Your uncle's contracting business? Bankrupt. Your friend's parents' restaurant? Closed. Your neighbor who just bought that 3rd rental property? Foreclosure notices on all 3. The unemployment rate shoots from 5% to 10%. That's 15 million people who had jobs and security and plans for the future. Gone. By November 2008, Americans have lost $8 trillion in wealth. $8 trillion. That's like every single person in America losing $25,000. Except it's not evenly distributed. Some people lost everything. Life savings, homes, retirement dreams, deleted. Here's what losing a house actually means. You bought in 2005 for $350,000. Put down $20,000 you'd saved for a decade. By 2009, the house is worth $200,000. You owe $330,000. You're underwater, owing more than it's worth.
You lose your job, can't pay the mortgage, the bank forecloses, you lose the house, you lose your down payment, your credit score drops 200 points, you can't rent a decent apartment, you move in with your parents or friends, your kids change schools, your marriage is strained, your future is rewritten. That's not theory. That's what happened to millions. The foreclosure crisis created neighborhoods of empty homes, lawns overgrown, pools turning green. Crime went up. Property values for the remaining homes plummeted. Communities hollowed out. College graduates couldn't find jobs, any jobs. People with engineering degrees were applying to work at coffee shops, and coffee shops weren't hiring. The stock market, which peaked at 14,000 in 2007, dropped to 6,500 by March 2009, cut in half. Your parents' retirement account that had $400,000, now it's $200,000, and they're 55 years old. How do you recover from that? Globally, the impact was catastrophic. Europe's economy crashed. Greece, Spain, Portugal spiraled into debt crises. In China, factories shut down because Americans stopped buying things. In Dubai, half-built skyscrapers sat frozen, monuments to hubris. This wasn't just a financial crisis, it was a psychological scar on an entire generation. Millennials entered the job market in the worst economy since the Great Depression. Many never caught up. Their lifetime earnings are still lower than they should be. Trust in institutions, banks, government, Wall Street shattered. And we're still dealing with the aftermath of that broken trust today. The government had to act fast. October 2008, Congress passes the $700 billion bank bailout, officially called TARP. The idea? Buy the toxic assets from banks, inject money into the system, prevent total collapse. People were furious. Why are we bailing out the banks that caused this? Why not help homeowners? The answer was cold but real. If the banks all fail at once, there's no economy, no loans, no credit cards, no paychecks. The entire system stops. The Federal Reserve dropped interest rates to zero. They started quantitative easing, basically printing money to pump into the economy. They became the lender of last resort, keeping banks alive. Some banks paid back the bailout money with interest. Taxpayers eventually made a profit on some of it, but that didn't help the family who lost their home. In 2009, Obama's stimulus package injected another $800 billion into infrastructure, unemployment benefits, and jobs programs. It helped, but recovery was slow, painfully slow. New regulations passed. The Dodd-Frank Act created rules to prevent this from happening again. Banks had to hold more capital. Subprime mortgages were restricted. Risky trading was limited. Wall Street hated it, said it would kill innovation, but the alternative was letting them blow up the economy again. So, what did we learn? Lesson 1. When everyone says it's different this time, run. It's never different. Gravity still exists, math still works, bubbles still pop. Lesson 2. Debt is dangerous when everyone takes it on at once. Borrowing isn't evil, but when an entire economy is over-leveraged, when everyone owes more than they can pay, the collapse is inevitable and brutal. Lesson 3. Complexity hides risk. Those mortgage-backed securities were so complicated that even the people selling them didn't understand them. If you can't explain the investment to your grandmother, you shouldn't buy it. Lesson 4. Incentives matter. When banks can make loans and immediately sell the risk to someone else, they stop caring if the borrower can actually pay. When rating agencies are paid by the companies they're rating, their ratings become worthless. Lesson 5. Too big to exist is too big to exist. When a company is so large that its collapse threatens the entire economy, that's a company that needs to be broken up or heavily regulated. Remember that waitress who got the $500,000 loan? She lost the house, declared bankruptcy, started over. Today, she's rebuilt her life, but she'll never look at banks or debt the same way.
Here's the thing. We recovered. It took years. It was painful. People suffered, but we did recover. The stock market hit new highs. Unemployment dropped. The economy grew. America is resilient like that. But we also forgot. Already, regulations are being rolled back.
They're too restrictive, they say. We need to let banks innovate. Sound familiar? The crisis taught us that markets aren't rational. People aren't rational. When fear or greed takes over, logic disappears. And when that happens on a massive scale, everyone pays the price. The question isn't if it'll happen again. History says it will. The question is, will we see it coming? Will we remember what happened last time? Will we act before it's too late? Because right now, somewhere, someone is selling a dream that sounds too good to be true. And history suggests it probably is.